I want to start with something that Jamie Dimon said out loud in front of an audience of financial professionals last year. He was asked about the first signs of stress appearing in the private credit market, the first defaults, the first funds showing cracks. And he said this: when you see one cockroach, there are probably more. Jamie Dimon was talking about a market that most people who own a 401k, a pension, a savings account, or a bond fund have never heard of, a market called private credit. And the reason you have never heard of it is the same reason it is about to become the most important story in global finance. It operates in the dark, no regulatory oversight, no public disclosure, no mark-to-market requirement, no quarterly earnings call where a CEO has to explain to analysts why the loans they made in 2021 are no longer performing. Just $4 trillion in capital deployed into companies that could not get a bank loan, generating returns that looked extraordinary when interest rates were zero and are now generating something else entirely at 3.5% rates. As of April 2026, Apollo has gated its $25 billion private credit fund. Ares has capped redemptions after withdrawal requests hit 11.6% of assets. Blue Owl capped redemptions on its $36 billion fund after withdrawal requests hit 40.7% of shares. Blackstone's flagship private credit fund, BCRED, absorbed $3.7 billion in redemption requests in a single quarter. The combined market cap wipeout across Apollo, Blackstone, KKR, Ares, and Blue Owl has exceeded $265 billion since September 2025, and the U.S. private credit default rate has reached 5.8%, according to Fitch Ratings, the highest level since the metric was first tracked. Jamie Dimon said he saw one cockroach. What I want to walk you through today is not the cockroach. It is the infestation behind the wall. And what happens to the Federal Reserve, to gold, to the dollar, and to every investor sitting on the sidelines when the wall comes down. Subscribe now. Here is the mechanism. Write this down, because this sequence is the reason private credit is not just a Wall Street story. It is the sequence that connects a $4 trillion shadow market to the most consequential monetary policy decision the Federal Reserve will make in 2026. Step 1. After the 2008 financial crisis, regulators forced banks to hold more capital, restrict their lending standards, and pull back from the most leveraged segments of corporate lending. Small and mid-sized businesses that could not meet the new, stricter bank standards needed to find money somewhere else. Enter private credit. Firms like Apollo, Blackstone, Ares, KKR, and Blue Owl stepped into the gap, offering direct loans to companies that banks had rejected, at higher interest rates than banks would charge, with fewer covenants and less regulatory scrutiny. The business model worked as long as two conditions held. Interest rates stayed low so borrowers could afford the floating rate loans, and the economy kept growing so the companies being lent to remained viable. From 2010 to 2021, both conditions held. Private credit assets under management grew from roughly $250 billion to $1.2 trillion. Returns were stellar, defaults were minimal. The major pension funds, sovereign wealth funds, and eventually retail investors poured money in. Step 2. In 2022, the Federal Reserve began the fastest rate hiking cycle in 40 years. The interest rates on private credit loans are almost universally floating. They reset with the benchmark rate. When the Fed funds rate moved from 0 to 5.25%, the interest rate on every floating rate private credit loan moved with it. A company that borrowed $100 million at 6% in 2020 was suddenly paying 11% in 2023. A company that was generating just enough cash flow to service its debt at 6% was no longer generating enough cash flow to service the same debt at 11%. The interest coverage ratio, the metric that measures how many times a company's earnings cover its interest payments, collapsed across the mid-market borrower universe. By early 2026, according to reporting from multiple credit analysts, interest coverage ratios for many mid-market firms had fallen below 1.0 times. Not just tight, below 1.0, meaning these companies are not generating enough cash to pay the interest on their existing debt, let alone repay the principal. Step 3. Private credit fund managers responded to the coverage ratio collapse with a tool that has a pleasant-sounding technical name and a deeply unpleasant economic reality, payment in kind, or PIC. Instead of receiving cash interest payments from borrowers who cannot afford to pay in cash, the lender agrees to receive the interest in the form of additional debt. The company's interest payment is added to the principal of the loan rather than paid out. The lender books the PIC interest as income. The loan balance grows, the company's debt burden increases, and the problem that caused the cash flow shortfall, too much debt at too high a rate, becomes worse with every passing quarter. According to KBRA and Fitch Ratings, distressed PIC arrangements reached 6.4% of total private debt volume in the first quarter of 2026. That is the technical term for what happens when borrowers cannot pay their interest in cash, and lenders agree to pretend the problem is not a problem yet. In plain language, it is amend and pretend, extend and pretend. The zombie company stays alive on paper. The loan stays performing on paper. The fund does not have to write it down until it does. Step 4. In September 2025, the pretending ended for two companies that were not small enough to ignore. First Brands, an auto parts manufacturer, filed for bankruptcy. Tricolor Holdings, a subprime auto lender, collapsed amid fraud allegations. JP Morgan absorbed a $170 million loss. These were not obscure companies. They had been financed by some of the largest names in private credit. And Jamie Dimon's public statement about cockroaches was not rhetorical. It was a warning from the CEO of the largest bank in America that he believed the visible defaults were not the complete picture. Step 5. Here is where the story moves from Wall Street to your portfolio. When investors in private credit funds began to understand what distressed PIC ratios and rising defaults meant for the value of the assets inside their funds, they did what investors always do when they realize an asset is worth less than they paid for it. They tried to sell. In Q1 2026, Blackstone, BlackRock, Morgan Stanley, and Cliffwater collectively received more than $10 billion in redemption requests. Goldman Sachs analysts estimated the retail private credit sector could shed between $45 billion and $70 billion in assets over the next 2 years. And the funds responded to this wave of withdrawal requests by doing something that every fund document disclosed as a possibility, but that every fund salesperson described as a theoretical protection rather than an expected outcome. They gated. Apollo gated on March 23rd. Ares capped redemptions the following day. Blue Owl capped on April 2nd after requests hit 40.7% of shares in one of its funds. The investors who wanted to leave discovered that the gate was locked, not because the assets had no value, because the assets had no liquidity. There is a difference, and that difference is the most important thing you need to understand about what happens next. Now let me give you the historical parallel that everyone in financial media is avoiding because it is uncomfortable and because the people who could draw it most clearly are the same people who have money in these funds. The parallel is 2007, not 2008. 2007. In June 2007, two Bear Stearns hedge funds that were heavily exposed to subprime mortgage securities began experiencing losses. In July 2007, Bear Stearns suspended redemptions from those funds. In August 2007, BNP Paribas froze 3 investment funds, citing an inability to value their mortgage-backed securities. In each case, the institutions involved insisted the problems were contained, idiosyncratic, not representative of the broader market. The language was almost identical to what Apollo, Ares, and Blue Owl have been saying in their investor communications in Q1 2026. Manageable, temporary, a feature, not a bug. And the reason that language is familiar is not because the people saying it in 2026 are dishonest. It is because the mechanism that produces private credit fund gates in 2026 is structurally similar to the mechanism that produced mortgage fund gates in 2007, a sector that grew rapidly in a low-rate environment. Loans made with insufficient margin of safety, a rate shock that exposed the insufficient margin, borrowers unable to pay, lenders using accounting flexibility to delay recognition, and then investors trying to exit simultaneously from an asset that is, by construction, illiquid. There is one critical difference between 2007 and 2026 that matters enormously for understanding what the Federal Reserve does next. In 2007, the Fed had room to respond. The Fed funds rate was 5.25%. The Fed could cut to zero. It did. The Fed balance sheet was $900 billion. The Fed could expand to $4 trillion. It did. The combined effect of rate cuts and balance sheet expansion provided enough liquidity to prevent a private credit crisis from becoming a complete financial system collapse. In 2026, the Fed funds rate is 3.5 to 3.75%. Core PCE inflation is running at 3.1%, with monthly prints of 0.4%. The Fed cannot cut to zero without deliberately igniting the inflation that oil above $100 per barrel has already stoked. And the Fed balance sheet is already $6.5 trillion, having been expanded through 3 rounds of quantitative easing and what the Fed calls reserve management purchases, which is the 2025 name for a 4th round of expansion that the institution does not want to publicly acknowledge. The Fed's tools are constrained. The problem is not constrained. That asymmetry is what makes 2026 different from 2007 in the way that matters most for investors who own gold. Let me now walk you through exactly why private credit stress is the most powerful remaining catalyst for the most extreme version of gold's structural bull case, because the connection is not obvious, and most of the coverage of this story treats it as a Wall Street problem rather than a monetary policy problem. Here is the mechanism. When private credit defaults rise to the level where they begin flowing into the banking system, which happens when banks that lent to private credit funds through subscription credit facilities and leverage arrangements begin recognizing losses, the Federal Reserve faces a choice that it has faced twice before in modern history. In 2008, it chose to expand its balance sheet and cut rates to zero. In 2020, it chose to expand its balance sheet and cut rates to zero. Both times, the decision was straightforward because inflation was either absent or falling. In 2026, the decision is not straightforward. Cutting rates into 3.1% inflation accelerates the inflation. Holding rates while the private credit sector generates banking system stress extends the stress. And the only tool that resolves both simultaneously, the tool that provides liquidity to the financial system without explicitly cutting rates, is the one the Fed already began deploying in December 2025 at $40 billion per month under the name reserve management purchases. When private credit defaults reach the level where banking system stress becomes visible and undeniable, the Federal Reserve will expand that program, not to $40 billion per month, to whatever scale is required to prevent a systemic event. And when the Fed expands its balance sheet in response to a credit crisis, while inflation is simultaneously running at 3% above its target, it is choosing monetary debasement over financial stability. That choice, the explicit prioritization of preventing a financial crisis over maintaining the purchasing power of the dollar, is the most extreme version of the structural gold thesis. It is the scenario that J.P. Morgan's $6,300 year-end target, Goldman Sachs's $5,400 target, and Deutsche Bank's $6,000 target do not fully price because they assume a more orderly resolution of the credit stress than the current data supports. The private credit time bomb is not a gold story, but when it detonates, it becomes the most powerful gold story in this cycle. Now let me give you the numbers that the financial press is not putting together in one place, because the data exists and it tells a story that is more advanced than most investors realize. In Q1 2026, the largest private credit managers collectively received more than $10 billion in redemption requests. Goldman Sachs analysts estimate the retail private credit sector will shed between $45 billion and $70 billion in assets over the next 2 years. That is the reversal of nearly $200 billion in inflows that poured into these funds over the previous 5 years. The $222 billion in retail private credit assets that existed at the end of 2025 is now in active contraction for the first time since the sector's post-2008 creation. The Fitch Ratings U.S. private credit default rate stands at 5.8% for the trailing 12 months through January 2026. Morgan Stanley projects that number could reach 8%, more than 3 times the 2 to 2.5% historical average, with the highest concentration of risk in software lending and healthcare roll-ups. The $265 billion in combined market cap that has been erased from Apollo, Blackstone, KKR, Ares, and Blue Owl since September 2025 is not a valuation correction. It is the equity market telling you that the earnings power of these businesses is impaired because the asset quality of their loan books is impaired. And the impairment is accelerating rather than stabilizing because the two forces driving it, elevated interest rates crushing borrower cash flows and AI disrupting the enterprise value of software borrowers, are both intensifying rather than moderating. Here is the number that connects all of this to the Federal Reserve in the most direct way possible. Private credit funds, particularly the larger institutional vehicles, borrow from banks through what are called subscription credit facilities. These are revolving credit lines that the funds use to make new loans before they draw down committed capital from their investors. The banks that provide these subscription lines have direct exposure to the quality of the underlying private credit portfolios. When private credit defaults rise, the subscription lines become riskier. When investors try to redeem and funds gate those redemptions, the subscription lines get drawn as funds attempt to meet partial redemption requests. The banks that lent to these funds begin marking their exposure to fair value, and when a bank marks a significant loan exposure to fair value in a deteriorating credit environment, the process that follows is familiar to anyone who studied 2008. Provisions rise, capital is consumed, lending standards tighten, credit availability for the broader economy contracts, and the Federal Reserve, watching the credit channel tighten in real time, faces the same binary it has faced in every previous credit crisis: inject liquidity or accept contraction. Now, I want to be precise about the counterargument because serious people are making it, and it deserves a serious answer. The counterargument is this: private credit in 2026 is not subprime mortgages in 2007. The underlying assets are corporate loans to mid-market companies, not residential mortgages to borrowers with no documentation and no equity. The leverage in the system is lower than 2008. The investor base is predominantly institutional rather than retail. Banks have relatively limited direct exposure, and the gating mechanisms that Apollo, Ares, and Blue Owl have deployed are specifically designed to prevent a fire sale of assets. Redemption caps give the funds time to sell assets in an orderly way, preventing the kind of forced liquidation that turned 2008's credit losses into a financial system collapse. Therefore, the private credit stress of 2026 is painful but containable. It does not require a Fed bailout. It does not trigger a monetary policy crisis. And it does not produce the kind of balance sheet expansion that drives gold to $6,300 per ounce. This argument is worth taking seriously, and here is the precise reason it underestimates the current risk. The argument assumes that the gating mechanisms will work as designed, that orderly asset sales will produce enough liquidity to meet redemption demands without triggering mark-to-market losses that drive additional redemption demands from investors who see the NAV declining. But the data from Q1 2026 already shows that assumption under stress. Blue Owl's $36 billion fund received redemption requests of 40.7% of shares. Not 5%, not 10%, 40.7%. That level of withdrawal pressure cannot be met through orderly asset sales in a private credit market where deal flow is slowing and secondary buyers are demanding significant discounts. The gate is a pressure valve. But when the pressure is 40.7% of assets trying to leave simultaneously, the valve and the tank are not designed for the same scenario. And critically, the argument ignores the AI disruption channel. Approximately 20 to 30% of most private credit portfolios consist of loans to software-as-a-service companies. These companies built their valuations on recurring revenue, high gross margins, and the assumption that software development would remain expensive and specialized. Generative AI is destroying both of those assumptions simultaneously. The enterprise value of SaaS borrowers is eroding as their products become easier to replicate, their pricing power diminishes, and their customer retention weakens. When enterprise values fall below debt levels, the loans become impaired regardless of whether the borrower can currently make interest payments. The AI disruption channel is not a future risk. Blackstone's BC Red already marked down loans linked to SaaS companies, including Medallia, in February 2026. Its fund reported its first monthly loss in 3 years. The cockroach is visible. What matters now is how many more are behind the wall. Let me close with the two indicators I am watching most closely. to determine when the private credit stress becomes a monetary policy event rather than a credit market event. Because the transition between those two states is the moment when the gold thesis moves from structural to urgent. The first indicator is the banking system exposure disclosure. The major U.S. banks, J.P. Morgan, Bank of America, Goldman Sachs, Morgan Stanley, report quarterly on their exposure to private credit funds through subscription credit facilities, leverage arrangements, and direct co-investments. When any of these institutions reports a significant increase in loan loss provisions specifically attributable to private credit exposure, the stress has crossed from the shadow banking system into the regulated banking system. At that moment, the Fed's response framework changes from monitoring to intervention. Watch the bank earnings calls, watch the loan loss provision language. The second indicator is the Fed's Reserve Management Purchase Program monthly disclosure, currently running at $40 billion per month, an amount that is doing quiet work absorbing Treasury supply that the private market is not fully absorbing. When that number rises to $60 billion or $80 billion per month, it confirms that the Fed has expanded its liquidity provision in response to financial system stress. That expansion, whatever name the Fed gives it, is monetary creation. And monetary creation in a 3.1% inflation environment is the most powerful remaining catalyst for the institutional gold targets that J.P. Morgan, Goldman Sachs, and Deutsche Bank have published and maintained through this entire volatile year. There are two types of investors watching the private credit gate announcements from Apollo, Ares, and Blue Owl. The first type sees a Wall Street problem, a sector they do not own, managed by firms they do not follow, affecting borrowers they have never heard of. They are not watching the bank earnings calls for loan loss provision language. They are not tracking the Fed's reserve management purchase disclosures. They will discover the connection between private credit stress and their gold position, their bond portfolio, and their dollar savings at the moment the Fed announces the intervention, by which time the market will have already moved. The second type understands that in a financial system where $4 trillion in shadow credit is now experiencing its first genuine liquidity crisis, where the Federal Reserve's capacity to respond is constrained by 3.1% inflation and a $39 trillion debt load, and where the one tool that resolves both problems simultaneously is the one that debases the currency, the private credit time bomb is not a separate story. It is the trigger. The mechanism is already in motion. The gates are already up. The cockroaches are already visible. Watch the bank earnings calls. Watch the reserve management purchase disclosures. And understand that when the wall comes down, the most powerful monetary response available to the Fed is the one that has been most powerful for gold in every previous cycle where it has been deployed. Most investors will not make that connection until after the fact. Now you do.